Welcome to another edition of Strategic Alternatives. I'm your host, Joe Coletti. In this episode, we're diving into the fast-moving world of biotech M&A and the changing dynamics of value creation. Recently, at RBC's Global Healthcare Conference in New York, we convened a panel of CEOs with a combined deal value of $29 billion under their belts this year. Roberto Bellini, Mark McKenna, Bill Meury, and Dan O'Connor, to discuss what it takes to successfully build and sell a biotech in today's markets. The conversation is moderated by our senior biotech analysts Brian Abrams, Luca Isi, and Greg Renza. Let's dive into the discussion.
Let's get started, and good afternoon, everybody. Welcome to the 2024 RBC Global Healthcare Conference. My name is Greg Renza, and we are delighted to present a panel today essentially on how to get a deal done, cracking that nut, getting a company to a stage where we have a positioning that there's attractiveness from a strategic. It also involves the attractiveness of just getting to the next step, but this can be a monumental task. Executing on a sale has its complexities, particularly when considering the assets, the pipeline, maybe the platform, even the financing environment and the market. Maybe we'll just turn within that context, just walk us through your respective paths to this most recent sale. Bill, let's start with you on Karuna.
I started in Karuna in late 2022, essentially. So I wasn't part of the founding team. That was Andrew Miller and Steve Paul. And look, when I started, I knew that the company had two value creation paths. It's no different for any company. There's the standalone path, and then there's, of course, M&A. I know that the only path that I controlled was the standalone. And I was very deliberate in not speculating about M&A. I think it destroys value and doesn't create value. When I started the company, we had about 125 people. 12 months later, we had almost 300 people. There was a foundation in place when I got there. But we were in the middle of phase 3 trials. We focused on making sure ClinDev, ClinOps, biostats, pharmacovigilance, CMC, and then, of course, all the SG&A functions were locked and loaded. And we were focused on only one thing, building the company. And I believed, certainly in that situation, that we could commercialize the product. It was not intimidating to me. It was not a lunar landing. It was infinitely doable. I don't subscribe to the notion that small companies are good at development and big companies are good at commercialization. I get why that myth exists. And I think it's relevant because if you build a great company, then you have optionality. Put a for sale sign around your neck and it's not a good look. And ultimately, when a buyer does show up, if they show up, which I don't think anyone should count on, they're going to look at how the company's being operated. And their diligence is going to be sophisticated. It's going to be complete. It's going to be precise. And they're going to want to make sure that they're not acquiring a problem here. And if you have an experienced, sophisticated buyer on the other side, and we did in BMS, it made the process run relatively smoothly.
Yeah, maybe just picking up where Bill left off, this idea of focusing on inputs, not outputs, focusing on building a great company, I think is a common theme you're going to hear from each of us out here. I don't know the other two gentlemen, but Bill and I both came from big pharma, and having sat on the other side of the wall, you kind of smell the sellers, and it not only destroys value, it oftentimes ruins the deal. And I came into Prometheus post the B round, $50 million valuation. Left big pharma. I was running a $2 billion revenue business. And a guy named Tachi Yamada, many of you probably know, called me about this little platform coming out of Cedars-Sinai, and had a lot of great prospects for bringing precision medicine into immunology. But we didn't have a development candidate at the time. So here you have a commercial-minded CEO going to run like an early-stage company without a DC, but the tools were there. And what we had to do was put them together. And it had a commercial stage diagnostic business to enable precision medicine. But what we learned really early on is that, investors struggle with mixed business models. So we had to spin that out to investors. The second problem we had was that we didn't have, traditional venture investors involved in the company. And it took us 1.5 years to raise capital in that environment. And once we did, obviously we prepared for IPO, and the flywheel was moving. But everyone sees like $14 billion, $11 billion outcome. You're like, oh, that sounds easy. There are many times where there was almost a crash landing on the moon, where we almost went bankrupt. I remember sitting in my CFO's office and asking her, what happens if we can't raise this round of capital? She goes, we'll just file these forms and, file bankruptcy and close the doors. I was like, okay, well, what's behind door number 2? She goes, we're going to raise the money. And we ended up doing a partnership with a European partner on our second program in Europe. That provided us with $20 million and confidence for investors to come in. What most people don't know about that story is I flew over to Germany using my United Airlines points. That's how desperate things felt. True story. And so, it was a scrappy team that, kind of took this thing from a, small idea to changing the game in I&I, and, honored to be here today to share more insights.
I probably have a very different background from these two gentlemen. I came more from the investor side in a family office, and then moved over into a couple of operational roles and became a very, very young CEO at BELLUS in 2010. I was 30 years old. Ran a program for 7 years that failed. The company was only TSX listed, essentially a micro cap at that moment in 2017. And the team, we wanted to do another project, and we went out and we in-licensed a chronic cough drug that was preclinical in 2017. And interestingly, kind of like the whole investment hypothesis, Merck had just acquired Afrin, so there was kind of like big pharma interest. And probably one of the dumbest things I could have done when I pitched, doing the in-licensing at the board, was I told the board, I was like, listen, we're just follow this path. We're going to run the same phase 2 study. We're going to get the data, and we're going to sell to big pharma. And honestly, I spent the next 7 years trying to walk that back with my board. I think very quickly I realized that it was going to take a lot of patience to kind of make that happen. And it was much more important to focus on building the business and having the ability to keep building that business over the long term. And to Bill's point, I think that as the company grew, we were building our own confidence up. Like, we were absolutely ready to launch the drug on our own. And I think that that's something, when you think about the emotional state, the confidence that's in the management team, like, you need to have that kind of ability to be able to take that next step in the company. Because I'm sure we're going to go through it, but I think M&A, the stars need to line up.
The approach I took at Ambrx really was a different situation. The company had been in existence for 20 years and done some great work, but had IPO'd and saw a pretty steady decline since its IPO. So I think probably within 2 weeks of taking the role of CEO, we were getting delisted from our exchange that we were on, which wasn't a fun day. But we then really, the approach was what all the other gentlemen have said on the panel. I'm grateful we did it, which was that we just focused on what we needed to do to develop the company. And that was really triaging. It's not just one thing. A lot of people have said, you turned Ambrx from 38 million market cap to $1 billion sale to J&J. How'd you do that? And my answer always is, it's not one thing. It's multiple things coming together at once. But it's definitely not focusing on selling the company. Because when you do that, again, it ripples into pretty much everything you do, and it becomes a virus. I specifically did not go out and solicit anybody on any of the programs. Really what we did was just heads down, execute, build the team, work with great people, and, show solid development and communicate, but not reach out, not knock on the door of, the potential pharma partners. Only footnote I put there is, if you have an asset you're looking to sell, then by all means you should look to sell it, right? There's things you're not working on that you should sell because maybe somebody else can do something with it. But if it's your active developmental program, doing any kind of overt, knocking on the door of pharma to sell, I think is a bad thing. It generally doesn't work. It makes you lose your focus on what you're doing. And eventually, if you do good work, they're going to come to you anyway.
And certainly a common theme that we're hearing is just the commitment to focus and what those results yield, certainly in the face of uncertainty. Talk a bit about having a real failure, a clinical failure, where you had to pick things up, redefine a program, run another phase 2 study, and basically reestablish the value proposition that you probably remember as you were in licensing the product.
Yeah, absolutely. And I'm happy to do it in the context of kind of thinking about it from an M&A perspective. So as I was mentioning, it was a preclinical program that was a fast follower to Merck. Even based off of phase 1 data, we showed differentiation on the side effect profile compared to Merck that enabled us to do a NASDAQ IPO. So we cross-listed, raised a lot of money, brought in a whole lot of great investors. Market cap of the company was over $1 billion going into our phase 2 readout. And I'd say that, very largely all investors thought that trial was going to be positive. So there were very high expectations. And at the same time, in the background, we were talking to a number of pharmas. And one of them in particular made it very, very clear to us that if we were going to have positive data, that they were going to make an offer. And so there was a lot riding on the data, and the data came out negative that day. So it was a surprise to all of us. Stock went down 80%. And I think we saw a path forward. There was a pre-specified subgroup, and I'm not going to go through all the details of that, but we saw that patients that cough less were diluting the results. We ended up running an enrichment trial with patients that cough more and had really great phase 2b data. But from an M&A perspective, what was very interesting was that thereafter, that big pharma cooled completely on the space. And so even as we kind of moved into our phase 2b data and read out on that phase 2b data, their priorities had changed. They were no longer in the market to do M&A. They were ready to kind of offer us, a licensing deal, which we were not interested in. So maybe just another kind of interesting view of how the results and the timing of those results and aligning that with the priorities of potential acquirers is very important.
Maybe to further build on that, Dan, and you touched on this a little bit, but Ambrx was a significant turnaround story from when you joined until you ultimately sold the company. I'm curious, what were some of the key aspects to that?
Actually, pharma does pay attention to the market's reception of a company. Okay. It's sometimes people will say, well, if your stock is at $2 a share, that's a great buy for a pharma. Well, they'll just come in and scoop you up. I think it's the opposite. There's a psychology to that I think impacts. And it's also another third-party validation. The market is validating the technology. In terms of, actually, I wanted to add one other thing. Even though you don't, just going back to that last question, always be ready for it, right? Build your data room. That was always something that, actually from the beginning, we actually had the skeleton of one existing when it came to the company. But work to get that in shipshape. Just because if you do end up having those conversations, you're going to want a very well-honed data room. And I think Bill said it's one of the things that you've got a scorecard when they're looking at you. Are you a mature company? Do you have yourself organized properly? And a good data room definitely demonstrates that. I think it's really all the things we all know to do, but just going and doing them, right? Finding the right people, putting them into the right positions. Developing a strategic communications messaging. Don't be a CEO in the closet, right? I think at Ambrx, really getting the right people in and being very fortunate that I had colleagues who were willing to work with me again. A couple in particular had the opportunity to really start to dig into our data. And, the more we looked, the better, the more we liked it. I think to your other question before about when studies don't work out, that reaction, it can be the opposite too. You can have great data and the market doesn't react, which is, I think, even a worse situation to be in sometimes.
I think just to add on real quick, when you think about the overlay between the investment community and the strategics, the last thing a head of M&A wants to do is go out and do a deal to watch there's, a negative reaction. And they do look at analyst reports and they look at price targets when they show the board to better understand, are we overpaying or underpaying? How should we think about this deal? So the ratings do matter. In that context, I get it. Some investors
ratings matter.
In the context of investors, I get it. Most people overlook that, but in the context of strategics, there is a value there. And the only other thing I would add there is on the question about data room. I think it's a really good point to be organized. But there's also a mistake that a lot of companies make by showing too much too early. And strategics are going to be naturally doing diligence. They may not even be interested in your company. They're looking at all the different compounds in that particular space. Yeah. They're doing competitive intel here. And so I think you really need to be very thoughtful about when and how you disclose anything. And to what end? What is your, being able to understand from, having been on the other side, well, what are you trying to achieve? Are you looking at an acquisition? Is this a category you're looking to build? Where would this slot in? Like having some of those clarifying questions in advance kind of sends a signal to them that you're not for sale. So it's a fine line. You don't want to be overly like standoffish, but you also don't want to be like, here, let me show you everything I have.
And Mark, maybe building on that. So how do you protect that focus, but also acknowledge the potential blood in the water? And the blood in the water was essentially off of great data that you had disclosed a few months prior. Just walk us through how you balance the complexities of all those parties.
Yeah. So we decided as a board and management team that based upon the amount of people that were around the hoop, we wanted to see who was actually real. And we also had data coming in a few months. And so what we did is we ran a partnership process. And again, this is not for everyone. Each situation is bespoke and proceed at your own risk. There's no such thing as a non-dilutive deal, like from a partnership perspective. Yeah. But what we wanted to do was create optionality. In the event the data was mixed, the data was bad, obviously, we got 17 parties under CDA, we educated them, and then the data came out, and I remember on Saturday morning calling CEOs of 17 companies to let them know that there's no need for their teams to work over the holidays. Because we're not going to be licensing this drug. We're not for sale. We're proceeding to phase 3. And some of them really appreciated it, but others were like, well, this makes me want you more. And, so we went pencils down, went to the holidays, JP Morgan comes up, and, we were working these parties to optimize for the best outcome for the company. And we never were not genuine about it. But we also made sure that, the only way to get to an optimized outcome, in our view, was to have multiple parties bidding. And FTC, and I know we're going to get into that later, honestly played a big role in thinking through who we were going to sell to and at what value. And what would XYZ company need to pay who competes in that space to be commensurate with Merck? And at that time, things were at the height of the FTC, thinking about Amgen, Horizon. Our board was, very skeptical about, if we had to wait 6 months, 12 months, the time value of money, it just made sense to optimize the outcome, knowing that we had one horse that was clean. They didn't compete in the category, and were the ones that had done the most work.
Super helpful. Maybe just quick question on valuation. Once you do get that offer and that offer is on the table, how are you thinking about valuation? Like, let's say there's a scenario where there's an offer on the table that is a substantial premium to your stock, but still substantially below what you think is the NPV of the company. What do you do in that scenario? Like, maybe walk us through your thinking, Bill.
If you're running a company, you should have a very well-developed point of view. Not the CFO's point of view, not a banker's point of view, of what the intrinsic value of your business is. When you're managing the balance sheet and cash flow, you're worried about the low end of the range. And when you're trying to sell your company, you're thinking about the upper end of the range. And I think you really have to be realistic because, in my experience, if there's a mistake companies make, the smaller companies, biotech or emerging biopharma, is you overestimate the marketability of your product and you underestimate about 5 things: time to market, investment, basic risk, and you underestimate the inertia in the market, how hard it is to get these
market
things.
access.
Yeah, all those things. And if you have that well-developed view, your buyers are going to have it too. They know exactly what they think it's worth, and it doesn't matter what you think it's worth. It only matters what they think it's worth. And then, of course, if it turns into a competitive process, then all of a sudden intrinsic value is here, and then there's a market value. And there are a number of different reasons these premiums reach 70, 80, 90% or more, but start with what's the intrinsic value of the business. And people can debate all the assumptions and say, well, they're just assumptions. That's what you have to go on. If someone's going to write a check, the decisions that some of these large companies make, they're serious decisions. They don't want to get too many of them wrong. I think the equity research analysts and the point of view of investors is incredibly valuable for buyers and sellers because you'll think about it different. You'll challenge the conventional wisdom of a management team. And there is validation when investors believe in the business when analysts believe in the potential of the business, as long as it's a balanced sort of presentation of the fact, I think it's really important to do some of these deals, especially the larger ones. When you get into 5, 10, $15 billion or more, those are not small bets, no matter how much balance sheet you have.
Right.
And maybe just looking at, Mark, you brought up FTC and hearing about the deals mattering. How are you using that to inform?
It was part of it. It wasn't, I don't think, the top three in our specific situation. But even if you look more broadly, it was a light touch antitrust era. And that changed, 2 or 3 years ago. But even still, I think my numbers are right. Only less than 2% of all HSRs filings receive a second request. In the healthcare sector, it's 11%, right? The bigger the deal, the more likely. Now, if you get a second request, the numbers are also a little bit alarming. 35 to 45% of those deals will get recut or not done at all. It wasn't a major factor. It's not a mystery what the FTC is looking at. We were in the middle of an NDA filing, 450,000 pages, and making sure that in a transaction, the operations of the company between signing and close were not interrupted was important to us. And you have to think about that. But it's not at the top of the list. I think it's great headlines because of CGen and Amgen. But when you think about the numbers, 10% get a second request. Normal regulation.
So the only thing I would challenge that is how many are pulled and refiled. That number looks different.
But then it goes faster.
It does. But I would just say that Cerevel, good example, they got a second request.
Yeah, sure.
And I think that it's a factor. I think we both agree on that. It's a factor. It's not the deciding factor.
That's right. It does get more mysterious when the legal principle is not about market concentration or eliminating competition or preventing an entrant. It's when they're looking at the practices of one company relative to how those practices could be applied to a target. And I don't think that's a strong principle, and I think that's why many of these deals ultimately get cleared. And I think for the larger deals, it's probably, as Mark suggested, it could become a much bigger factor.
And on the law firm too, getting a group that's actually done it before multiple times is who you want. There's specialty firms out there that do just this, and there's the folks to work with.
That's right.
What about broader market and macro factors? Things like stock volatility, overall biotech sector sentiment, interest rates, even recession fears. How did that impact not only the development of and the maturity of your businesses to get them to a point where they were attractive acquisition targets, but just the overall process in talking to potential acquirers?
Yeah, I mean, look, you have to be aware of all the things that you just talked about. When there's uncertainty around interest rates, that's going to depress values, that's going to complicate financing. I think when your stock is acting like a mood ring rather than a true measure of value, that can complicate things too. Those generally should be more transient than permanent. If you owned a small business before the pandemic and it was a weak business, you probably didn't have a business after the pandemic.
Yeah, sure. Yeah.
But all the strong businesses before the pandemic are thriving today. And I think when you think about your company, all the macro factors that could impact it, whether it be the market or interest rates or the overall economy, regulations, if you're building a good business, you will get through these periods. And by the way, I think the investors think about it this way too. Buyers see it too. Yeah. They know the difference between what's transient and what is permanent. And if you have someone that really understands a particular area, understands your business, they have a need, they have the firepower to do it, the macro is not going to stop them from doing it. Because they're trying, as you know, you're solving for earnings and cash flow that's sustainable and long-term. We don't have forever assets, unfortunately, like in the consumer world. But that's ultimately what you're solving for.
I think it matters with regards to purchase price because of the fact that there's only so much premium that they want to put out there because they're concerned about the precedent that it's setting for future transactions. And so if one stock price is depressed, it takes a lot more for a board to rally around a 300% premium than it does a more traditional premium, right? And I think that the inverse is also true. I think about the cardiometabolic space. How many of those companies now have more than $5 billion valuations and kind of gotten overheated a little bit because the sector's hot, have almost become not transactable because of the price and the amount of R&D dollars that are going to have to go against that to run phase 2, phase 3 studies. And so I think it goes both ways here, and it'll be interesting to see, what these cardiometabolic companies do because of the fact that there may not be a pharma there willing to pay the premium, and these are expensive trials to run, and so they're probably struggling with how do I actually advance the company while there's a normalization of my market cap as data matures.
Yeah, I want to reemphasize the point around the premium because obviously the absolute number and how that matches up to an NPV estimate is very, very important, value driven there, but the premium is extremely important as well. So you're playing with both of those factors. And someone that lived through that very specifically, I can tell you that it was very frustrating. So, in our stock, we had, generated very, very strong phase 2B data, stock went up, did financing, and there was a lot of buzz around there could be M&A. We were a one product company, very strong end of phase 2 regulatory interaction that set up the phase 3. We also raised money off of that. And we said we're ready to move into phase 3. But as we got closer and closer to phase 3 and eventually started that phase 3, investors started thinking that, M&A is not going to happen right now, right? So some of the M&A premium in the stock was coming out. And then you're in that one moment. I don't know, you could say no and see if it works again in 6 months or 12 months. But otherwise, you're kind of committing yourself to going a much, much longer period of time. So you're in that one moment and you got to make the decisions about is this the right moment?
Maybe just a quick question on the kind of your broader views on how M&A and the outlook for M&A more broadly for the rest of 2024.
I personally think we're going to see a significant amount of activity. Everyone's busy. And it is the perfect storm with $320 billion of LOE going out over the next 7 years. You can either cut your way to a future or you need to start buying things. I think the challenge that I see right now is mature assets have already been taken. And it's going to force pharma to move earlier. And there also, my understanding is there's a lot more conversations going on around private companies now than public companies. And so I think that's probably a trend that we're going to see for a while. The big companies have to make moves. I think BMS, they got a $30 billion delta they got to solve for. And yes, Karuna is going to help with that, but they got to do a lot more. And the question is how much money they're willing to put on the table. And I think you're starting to see pharma making cuts so they can justify further deployments of capital into M&A.
Yeah, maybe the only thing I want to add to that, just a tidbit of info, just through our kind of, discussions on the M&A side, the companies that were the most interested in us were where there was high synergy, right? So the respiratory companies, okay? And then the LOE impacted companies. Those are the ones that had interested in us because the LOE impacted companies are desperate. They will build something new if they think that that's the right move, right? So it's forcing them to think much further outside the kind of normal kind of box.
Yeah, the only thing I would add is it's inevitable. They have to, right? Unless they do it themselves, they have to bring assets. Most of the times it was, in the late stage asset, it was how much revenue could that bring in and increase their versus how much they're going to have to spend because they have the money there to spend. It's just an accounting feature for them and how they get judged in the street.
I want to build on that a little bit more and really understand what pharma wants these days. You all sold companies with lead assets that were post proof of concept. Is that what pharma's looking for now? Are they looking at earlier stage, later stage, and then just maybe even building further, Roberto, what you said? Did you find in the process that pharma companies were really more interested in leveraging and building on their strengths and areas of expertise because that would enable synergies and help facilitate their diligence? Or as their franchises mature and they're looking towards LOEs, if they're genuinely looking to diversify and get into new areas?
If you're running a diligence process, one of the things you want someone to focus on are threshold questions because diligence can last months. There can be hundreds of people in it. And it's important for you in running your company that you understand what the threshold questions are, and they're not surprising. I think the first one is, strategically, do I want to be in an area? And I think if they go outside of an area of expertise and they build a new vertical or product line, they got to be sure that they have the capabilities to do it and that there's new product flow through that new vertical.
Yeah.
So that the hurdle there is going to be higher for any buyer. Same if you're building the company and you want to enter, you got to be smart because you can get your face ripped off pretty quickly if you don't do that right. That's number one. I think the second thing they look at is, do I have an approvable asset? Yeah, it's got to be novel, it's got to be marketable, but is the development and regulatory path here a mystery? Is it a minefield? And then the third thing is IP. You can't replace a patent cliff with a patent cliff. That's like beachfront real estate. It becomes very, very important. I think those are threshold questions.
Okay.
Then, of course, they'll layer in, well, what should the peak revenue potential, what does the P&L, earnings and cash flow, look like on this business? And I think that's how they think about it. And that's how they should think about it.
I think there's definitely a bias towards them buying assets that are in the footprint of their existing programs. I think it's pretty rare that they want to expand into some therapeutic indication that they don't have a presence in. I think the change to that, though, is if it's a platform technology and or if it's like something that happened with the checkpoints a while ago, right? So when you saw the PD-1 checkpoints and checkpoints really starting to come in, I think you see that a little bit with the ADCs now to a certain extent, that they're looking and saying we need a presence in this space because it is the future kind of thing.
I think going back to the cardiometabolic space, I think that CEOs of these companies are all getting questions from their board and from investors. If they're not in it today, well, how is it you're going to be a top 10 pharma company? You're not competing in the biggest category in the world. So I think that my bet is that, over the next 12 months, you're going to see those that are not in the space make bets because they want those questions to die down.
What does pharma think of a platform versus single?
At that point, talking about multiple ways to win to both with investors and strategics. But no one wants to buy a drug and have one indication reading out to have it not work out. That's not a good day. People lose jobs. And so I think that it's less likely that you see a big takeout on a platform itself. Like you think about a lot of these platform type of companies, until they actually generate assets, you're seeing like more partnerships, you're seeing smaller transactions. Why is that? Because pharma doesn't want to take the next 10 years to add on to their own development efforts. They're looking for near-term revenue, and I can tell you, time to market matters probably more than anything else in your DCF, right? And so your ability to demonstrate your launch timing with some conviction can be one of the most important aspects to your dialogue with pharma. Because if they have 2032 in their model and you're saying a 2028, that 4 years of sales matters. And so even if helping them, give them the rationale, the backup as to why it's 2028, can get you a much better proposal.
Yeah, I actually don't think they really look at platforms too much. Yeah. Honestly, I think that for exactly what you just said, they're looking at the asset. The reality is, they're focused on something that's been de-risked as much as humanly possible. There's a saying, you don't get fired for the deal you don't do. And then everything else is upside to them, right? And they'll tell you, sometimes like, yeah, we acquired this company and we didn't even consider this asset in the pipeline. And then I think it was the Medivine acquisition, BMS, or Merck found Keytruda, as an add-on type of thing. But that does happen. But I think in terms of the dialogue you're having, it's mostly almost always, what do you have in front of me? When's it going to get to the market? How much revenue is it going to kick off? And what's the POS?
Well, Bill, Mark, Roberto, Dan, thank you very much. And just join me.
Thanks for listening to another episode of Strategic Alternatives, the RBC Capital Markets podcast. Remember to subscribe to the podcast to stay up to date on all our future episodes. This episode was recorded on May 15th, 2024. If you'd like more information or to continue the conversation, please contact your RBC representative or visit rbccm.com/strategic alternatives. See you next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.